Hi guys, in this video I'm going to give you my understanding of the stock market, what it is, how it operates, and how to take advantage of it as a long-term investor. The stock market is a place where different players, like individual investors, fund managers, institutional investors, etc., trade ownership of parts of businesses called stocks. It's a zero-sum game, meaning that in order to buy one share of company XYZ, someone has to sell you one share of company XYZ. You cannot just buy it out of thin air. So the bigger the trade volume of a particular company, the better the liquidity and the smaller the spreads. So for example, Coke has an average trade volume of 15 million shares per trading day. So 15 million shares exchange ownership every single trading day, on average. In a bull market, there's plenty of liquidity. But in bear markets, it is really hard to find buyers because the sell volume is many times bigger than the buy volume. Remember, in a bear market, no one has to buy the shares investors desperately try to sell. Price spreads are becoming bigger and bigger, and the price plummets incredibly fast. The stock market is small in comparison to the bond markets, but it is by far the most talked about. The most important thing for you to understand is that the stock market is unpredictable. And you're gonna ask me, why is that so many media outlets and Wall Street try to predict it on a daily basis? Oh, it's simple. They are the middleman, the croupier. They make profits every time we make a trade. Every time you buy or sell, you pay fees, you pay commissions, or hidden fees like order flow nowadays. And why is it unpredictable? Well, first imagine for a second how many market participants are there. Hundreds and hundreds of millions of individual investors, complex high-speed traders, ETFs, index funds, millions of investment managers, quants, pension and wealth funds, and etc. Each and every market participant has different motives, ideas about valuation, and visions for the future. What moves the stock market? The two forces driving the stock market are fear and greed. We are humans and as such are influenced greatly by our emotions. And when people are greedier, the buy volume is higher and prices go up. It's called a bull market. When people are fearful, on the other hand, the sell volume is higher and prices go down. It's called a bear market. Once every 2 years, on average, the market will experience a stock market correction, a 10% drop. And once every 3.5 years, on average, there will be a bear market, a more than a 20% drop. The last bear market we experienced was in March 2020, when the MSCI World Index dropped a whopping 34%. Of course, it was followed by a bull market later that year, mostly due to monetary and fiscal stimulus by the major economies. How to take advantage of the market as a long-term investor? It's simple, the market is here to serve you. Let's suppose you buy 10 shares of company XYZ for $20 each, and you think that the shares are going to be worth $40 a share in 5 years. You can take advantage of the stock market volatility and buy more shares when prices drop below $20. Many participants will sell when they see the stock prices drop, but you as a long-term investor will not only brush aside the panic, but also double down on the opportunity and buy more. A real long-term investor should perceive stocks as groceries. The bigger the discount, the better opportunity to buy. As long as, of course, you've done all your analysis and you know what you're doing. Similarly, when you decide that it's time to sell due to the deterioration of the business, the loss of an important manager, or you just simply found a better investment, the higher the price per share, the better it is for you to sell. Therefore, you can take advantage of the stock market optimism and cash out. Please make sure to like and subscribe and comment in the section below. Thank you.